Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the link between the federal firing spree we're seeing and the national housing market, specifically mortgage rates. Logan, welcome back to the podcast.
It is wonderful to be here.
Wonderful to be talking to you. I know you've been under the weather, so we'll keep this one a little bit short so you don't have to stress your voice. I know you're also going on stage today, doing a big presentation.
Yeah, I'm going to be on stage in 2 hours, but hey, duty calls. You got to go through with it.
Duty calls. Well, our subject today is really interesting, and that is when you look at all the firings that are going on in DC, right? We've got at HUD. We just found out FHA is gonna take a pretty big hit as part of that HUD firing. We've got, of course, CFPB. A lot of things are not certain because you also have lawsuits. But from your perspective, what is all that firing going to do to the economy?
Well, if we're talking about what it does for housing, maybe the turn times of getting stuff done, things take a lot longer. If you need to get information from HUD, or if you have to get certain paperwork, whenever you do a sharp firing on a big scale, it's not like you have like robots coming in or productivity to like really kick in right away. So I think there's going to be a learning curve on how to adjust to a lower workforce. So things can take a little bit longer to get things done on the housing side. In the general economy, what we've always said is that the federal firings itself isn't going to be big enough to, tilt the economy one way or another when you have over 162 million people working. But the withdrawal of money, right, and the second or third effects of contracts done for this, this state had this contract from the government, stuff like that. When you put them all together, they can be material in that sense. And what was it, 5-6 weeks ago, we said, what if it's, hey, the plan, to lower mortgage rates, is to create, higher unemployment, weaker demand. And then Kevin Hassett, the White House counsel, comes after and 2-3 weeks after that podcast and says, hey, listen, we want to create higher labor supply and lower aggregate demand. So I always hate even bringing this up, but what if that was right? What if the whole thing was, let's just create higher unemployment? It's government workers or contracts tied to government money, so we don't really count that as anything against the economy. So I could see this happening. Maybe the unemployment rate rise up, they have one unemployment rate chart. Okay, this is what it is now, but if we take the federal government dollars out of the equation, the unemployment rate's here. Whatever it is, the fact that Treasury Secretary Bassett said they wanted the 10-year yield lower, the White House counsel said that they want to create lower demand and higher labor. It's happening. Right. And we won't know the full effects until you see the money being taken out of the system and then all the second or third variables in. So it's interesting in that aspect. On the economic side, on the housing side, it's just things are going to take a lot longer to get done. There's no work being done on the CFPB at this point.
Right.
And we'll see if that just a few transactions take a little bit longer to close now.
So it's interesting that you talk about second and third effects. So I have family in DC who are tied to the federal government or contracts with the federal government. So that's really, of course, you'd expect them to be affected by this. But I also have family and friends in 3 other cities, not anywhere near DC, who are either being laid off or probably going to be laid off because the money's for the contracts are going to dry up. And so that's where I think it does take longer to see what is that one of, what happens 6 weeks from now? What does it look like 2 months from now in those various places?
If you want to reduce demand, you withdraw money from the economy. Now, one way to do that is raise taxes. That's obviously not going to happen. They're in a point trying to get rid of the IRS, but withdrawing money out of the economy does have a second or third impact. So I think that's something we'll see down the line. Now, again, we are a very unique domestic GDP consumption economy. So uh, we'll see what the final tally is. But I think the federal workers are just one aspect. It's the second or third labor jobs that will come in a little bit later. But all that does is it'll take the unemployment rate higher, right? And if the Fed's unemployment rate target is 4.3%, and then if it goes above that, what do they do? I mean, this is going to be a very, very interesting discussion with the Fed. That if the unemployment rate rises because of what the government does, how does the Fed view that? Or is that something the Fed's going to go, hey, listen, you know, if we really wanted to get inflation toward 2%, this helps us as well. But then they got their dual mandate on the labor market. So it becomes even more fascinating with the Fed now, because it's been a while since we openly targeted American citizens to get them unemployed and then get money out of the system this way. So I'm really curious to think to like figure out what the Fed is thinking on this, because this goes, to the heart of their dual mandate.
So, we just did a reporting yesterday that Mark Calabria he's back at OMB, or he's at OMB, and he's going to, as part of that, have a role at CFPB. It's not exactly clear what that role is, because they have an interim director and they have a permanent director who still needs to be confirmed, but he's over there. And then the reporting that we saw, these days things come out on Twitter. There's not really a press release sometimes, but what we saw was that he has been tasked with being the one who oversees, like, bringing these independent agencies, what have been formerly independent agencies, all sort of under the OMB umbrella, so that the president has more direct control of them. So we talked about that as far as with the Fed. You and I have talked about that, but from your perspective, they've carved out the monetary policy of the Fed. Is that correct?
Yeah, they can't control what the Fed on monetary side, but how they regulate, banks or kind of their stewardship of looking at all the regulation around the banking system. They really want to get more control to the White House on all aspects, but the monetary policy they can't really touch. Now, we're going to go through a lot of courts and hearings on a lot of stuff, so who knows what the final tally is 6 months from now. But you see, this is really taking as many government institutions and bringing it into kind of one umbrella, so the White House has a little bit more control over everything.
Does that give you pause at all, or are you like, it's fine? That's what presidents do.
I really have to see what can legitimately be done via the courts, or what the final thing is. There's a lot of things that are just moving around right now that it's easy to get the headline on it, but what can legally hold water or not is really the monetary policy is the one that, I know President Trump probably wants that, but that's the one thing he can't have yet. So, and again, I just think this is a very, very interesting new variable for all of us. I think all of us that have tracked economic cycles for decades here, this is the first time where we have the government seeking higher unemployment, where we have the White House counsel say we want the labor supply, and that goes directly to the Fed's dual mandate. So it is interesting. Treasury Secretary Bassett came out this morning and said, well, the supply of long bonds, to issue debt, we're not going to really touch that now. He criticized Janet Yellen for doing that, but you can really see that the 10-year yield is really on their mind out there. And we've talked about this. If somehow mortgage rates go lower and people are buying homes again, and it's, even though the unemployment rate rises and it's really on the government side, to me, I think Trump believes that's a win-win for him, right? Because then everyone gets to see, well, rates are down, right? And this is one thing where I think the Fed doesn't read the room you know, and reading the room is like people. It's not so much just inflation; it's just the cost of living, the cost of getting a mortgage, the cost of getting a car loan. All these things are elevated to a degree. If somehow he gets to bring that down, even if it's at the cost of employment, Trump wins on this. I think they will spin this off as, hey, listen, we did this. It was us. We withdrew the money, and now we could get some consumption going. And it's something actually that the builders need. When I went on CNBC and talked about, the builders' contraction in their confidence is really picking up steam. And we're at the stage right now where you don't have too much wiggle room left for employment. So it's one thing to fire government workers, but residential construction workers, you put that all together, you push that unemployment rate higher, you get less GDP for residential construction. Then you got more of an issue. But if rates go lower, solves that issue. So there's just a lot of moving parts here, and it's just fascinating because it's been not a while. It's the first time that I've seen where the White House is openly wanting higher labor supply. So I know a lot of people thought that was going to be a pure recession, but we're trying to figure this out. It really means that they want the 10-year yield lower. And I think everyone starts to feel a little bit better if that happens. It's an interesting game plan, but we joked about it 5 or 6 weeks ago, but here we are. And
Yeah.
it looks like this is going to be a full-blown game plan on this.
I think, I think it's interesting what you say about the Fed reading the room. You've been somebody who's called that out where they're like, oh, the housing's doing fine. And you're like, how is housing doing fine when it's been in a recession since 2022? But I do think that the tightrope that the White House is walking is like, there's a tipping point where those layoffs hit enough households, or these second, third order effects where that lower interest rate, that lower mortgage rate is one thing, but then you have, how far do those layoffs go? If it's just Washington, D.C., then the people in the rest of the country might be like, government workers, waste, fraud. If it gets into farther, that's where he might run into trouble.
This goes into another talking point that let's say hypothetically the unemployment rate goes up 1%. Okay, so we're 4 to 5. 95% of the country is still working, and mortgage rates are lower. Trump wins on this. Whether you agree or not agree, he is going to highlight this as, look what I did. I took all this action, and majority of the country is still working. Right? So in that context, it looks like that's the game plan. Look at Florida talking about banning property taxes. This is a housing play here. This is all a housing play. You don't talk about the 10-year yield going down. You don't talk about banning property taxes, all this stuff, if there isn't a housing component in here. And what we just said, when you have the 4th calendar year of the lowest home sales ever.
Yep.
Okay. This is not like a mild decline or anything like that. This is the 4th calendar year. This is why we always say, Fed staffers, stop telling the people or writing in the president's speeches that housing's rebounding. You only have a rebound when credit demand grows, purchase application data grows, and it's the 4th calendar year. President Trump is reading the room differently than the Fed is. And this is going to be a conflict battle, right? I'm invigorated because I want to see how the Fed operates in this environment. But if you look at it in that light, 1% unemployment rate increase, 95% of the country is still working, 5% unemployment rate historically still very low, but mortgage rates go lower, the 10-year yield lower. And this is not something we're bringing up. The Treasury Secretary talked about it. The White House Economic Council is talking about it. So it is fascinating how this all of a sudden became a housing story. So I'm just assuming, hypothetically, that whatever internal readings they're seeing out there or whatever surveys there, the housing story is a little bit bigger than what I think people are didn't give it enough credit on how big it is for them. So we'll again take it one day at a time, but it looks like that's the game plan.
It does. Well, I can only say that our timing, again, for our economic summit next week, where you're going to be our kickoff headline speaker, we've got amazing economists, could not come at a better time because there's a lot going on. We need the insights and analysis of this entire group of people we're bringing together.
You know, because of everything that's happened, that presentation of mine is going to be more different than any presentation I've ever done. It's really going to be about the state of the economy currently and what it is, because you know the bingo card was that, you know, were they really going to front load the 10-year yield in 2025 as an agenda? And now we have multiple sources from the government saying this is part of the game plan. And how do you do that? Lower aggregate demand, higher labor supply. So yeah, it's very unique. It's our first time that we're dealing with this, but we're going to have to be on top of everything more than ever.
Absolutely. Logan, thank you so much for being on. Appreciate you. Hope you have a great presentation in Denver. I know you will. And we'll see you soon, and we'll see you next week in person.
Yes.